What if I told you there's an economic nightmare where everything you buy gets more expensive, but your job gets less secure at the same time? It's not a recession. It's not just inflation. It's a nasty combination that economists have a special name for: stagflation. And it's a quiet trap that can absolutely wreck your finances. So in this video, we're going to break down what this economic storm is, why it's a real threat right now, and most importantly, what you can actually do to protect your money before it's too late. So what exactly is stagflation? The name itself is a mashup of stagnation and inflation. And it's exactly what it sounds like: a toxic cocktail of three things happening all at once. First, you get high inflation. You already know this one. You feel it every time you're at the grocery store or the gas station. Your money just doesn't go as far as it used to. Your buying power is literally shrinking day by day. Second, you have a stagnant economy. This means the whole economy is basically stuck in the mud. Companies aren't really growing, they're not investing, and they're not making as much stuff, and that leads to the third and most painful ingredient: high unemployment. When the economy stalls, businesses get nervous. They stop hiring. They start looking for ways to cut costs. And you know what that means: layoffs. So suddenly, not only is your money worth less, but your job itself could be on the line. Think of it like you're fighting a war on two fronts. On one side, inflation is a thief, quietly stealing the value from your savings. If your savings account is earning 1%, but inflation is at 5%, you're actually losing 4% of your money's power every single year. It's like trying to fill a bucket that has a giant hole in the bottom. On the other side, the stagnant economy is threatening your main source of income: your job. You've got less money coming in, and the money you do have is worth less. It's a brutal 1-2 punch to your financial life. Now, you might be thinking this sounds pretty rare, like some weird theoretical problem. It's not. The US and a lot of other countries went through a brutal period of stagflation back in the 1970s. For nearly a decade, this was the economic reality people had to live through. So, how did we get there? A huge trigger was something called a supply shock, most famously the 1973 oil embargo. Geopolitical conflict in the Middle East caused oil prices to spike dramatically. And because oil is used to make and transport almost everything, the cost of doing business went through the roof for everyone. Prices for shoppers shot up, causing runaway inflation. In response to their own higher costs, and with customers having less money to spend, businesses had to cut back on production and lay people off. Unemployment soared. The US saw inflation jump from under 6% to over 13% by 1980, all while the economy was sputtering. For everyday people, it was a total disaster. Their savings were getting torched by double-digit inflation, and the fear of losing their job was always there. It completely upended what economists thought they knew. Before the 70s, the big theory was that inflation and unemployment were opposites. When one went up, the other went down. Stagflation proved you could, in fact, have the worst of both worlds. So if we know what it is, why can't we just fix it? This is where stagflation gets really dangerous. It puts the people in charge in a terrible catch-22. Normally, to fight high inflation, the Federal Reserve raises interest rates. That makes it more expensive to borrow money, which cools down spending and gets prices back under control. But in a stagflation environment, raising interest rates is like pouring gasoline on the fire. The economy is already weak and unemployment is high. If you make it even harder for businesses to borrow and invest, you risk kicking off a massive recession and even more job losses. Okay, so what about the other move? To fight high unemployment, the Fed would usually lower interest rates. This makes borrowing cheaper, encourages spending, and gets the economy moving again. But with inflation already raging, that plan risks sending prices into a complete death spiral. This is the policy trap. The tool you use to fix one problem makes the other problem worse. In the early 1980s, the Fed chairman, Paul Volcker, had to make an incredibly tough choice. He decided to crush inflation no matter what. He raised interest rates to unheard of levels, which did eventually kill inflation, but at the cost of a deep, painful recession and skyrocketing unemployment in the short run. It was a bitter pill to swallow. So why is this ghost from the 70s suddenly back in the headlines? Because a lot of the ingredients are starting to look eerily familiar. We've been battling stubborn inflation that just won't seem to go away. We're also seeing global supply chain problems, geopolitical tensions, messing with commodity prices, and signs that economic growth is slowing down around the world. Some economists are even calling the current environment stagflation light. They're warning that while it might not be a full-blown repeat of the 1970s, the risks are definitely on the radar. In fact, recent surveys from major financial institutions and economists show that a majority of global investors see stagflation as a dominant risk on the horizon. The world economy is walking a tightrope. Things like tariffs, shaky job markets, and stubbornly high prices are creating a perfect storm where the old rules might not apply. And while nobody can predict the future, the people who come out of times like these in one piece are the ones who saw the warning signs and did something about it. If you're getting some value out of this and want to learn how to build a stronger financial future, do me a quick favor and hit that like button and subscribe. We put out videos every single week to help you make sense of this crazy financial world. So, what does all this mean for your money? Look, you can't control the Federal Reserve or global politics, but you can absolutely control how prepared you are. This is your practical playbook for building a financial fortress. First, attack high interest debt. In stagflation, interest rates often go up, which turns variable rate debt like credit cards into a financial black hole. Every dollar you pay in interest is a dollar that's not fighting inflation for you, so get aggressive. Look into debt consolidation to lock in a fixed rate, or use a method like the avalanche or snowball to wipe out those balances. Second, build a rock-solid emergency fund. Job insecurity is a key part of stagflation. The goal here is at least 3 to 6 months of your essential living expenses. But don't just let that cash sit in a regular savings account where inflation can eat it for lunch. Put it in a high-yield savings account or a money market fund where it can actually earn some decent interest while still being safe and easy to access. Third, rethink your investments. A standard 60-40 stock and bond portfolio can really struggle during stagflation. This is the time to get serious about diversification and look at assets that tend to do well when inflation is high. This could include real assets. This means physical stuff like real estate or commodities like gold and silver. They often hold their value when paper money is losing its own. Value in dividend stocks. You want to look for solid, boring companies that have strong finances and can pass their rising costs on to customers. Think about sectors people can't cut back on, like consumer staples, healthcare, and utilities. Inflation-protected securities. Investments like Treasury inflation-protected securities TIPS are literally designed to go up in value with inflation, helping you preserve your buying power. And fourth, and I really believe this is the most important one, invest in yourself. The single greatest defense against job loss and inflation is your own skill set. In a tough job market, the people who are indispensable are the last to get cut and the first to get hired somewhere better. Use this time to learn a high-demand skill, get that certification you've been putting off, or build a side hustle to open up another stream of income. When the economy is stagnant, your personal growth can't be. Stagflation is a serious economic threat. It's that nasty combination of your savings being eroded by rising prices while a weak economy puts your income at risk. We saw how it shook households in the 1970s, and we can see some of those same warning lights flashing today. But being aware is the first, most important step. Panic is not a plan, but preparation is. By getting aggressive with debt, building your emergency savings, diversifying your investments, and relentlessly improving your own skills, you can build a financial life that is ready for whatever the economy throws at you. Don't wait for the storm to hit. The time to prepare is now. Take control of what you can, and you'll put yourself in a position of strength no matter what happens next. What's the one step you're going to take this week to make your finances just a little bit stronger? Drop a comment below and let me know. Thanks for watching.